Welcome back. You're tuned in to Inside Out on CNBC-TV18, where it appears there's a bit of a re-rating underway on PFC. And so the stock features today under our Swotlight segment. The stock has rallied 40% the last couple of months, and even post the rally, valuations appear reasonably as at around half times price to book. Now, part of the reason of cheap valuations could be that it's a government-owned entity. The company is a specialized financial institution in the power sector. PFC funds Gencos for capex and discoms for working capital needs. The central government schemes like Uday, they tasted limited success, but reforms implemented in the power sector have started taking shape and are giving a makeover to the sector. Hence, REC and PFC, they are well placed, but as we know, REC is owned by PFC. The Ministry of Power, state governments as well as distribution companies, they have implemented various reforms, and as a result, the viability of the power system has improved. This was necessary because demand for power has been growing, and further investments will be necessary for the power sector to expand to meet the growing demand. And the investments will only come if the power sector remains viable. The Ministry of Power has said there's a marked reduction in the aggregate technical and commercial losses of DISCOM in FY22. In fact, the AT&C losses of DISCOMs, they have declined significantly to 17% in FY22, which compares with around 22%. In September 2021, the Ministry of Power revised the prudential norms of PFC and REC, which stated that DISCOMs cannot avail financing from PFC or REC unless they draw up an action plan for reducing losses within a specific time frame and get their state government's commitment to it. The revamped distribution sector scheme lays down that funding under the scheme will only be available if the DISCOM commits to an agreed loss reduction trajectory. The 15th Finance Commission provided for an additional borrowing window to states contingent on them taking steps to reduce their DISCOM losses. Further, in June 2022, the Ministry of Power issued a late payment surcharge rule, which provided that unless the distribution companies promptly pay for their power drawn from the interstate transmission system, their access to the power exchange will be cut off. Well, while putting all these in place, the Ministry of Power also worked with the distribution companies to provide the necessary finances under the RDSS for undertaking the loss reduction measures. Implementation of the Electricity Rules 2022 has not only ensured that the outstanding dues are liquidated, but it's also ensured that the current dues are paid in time. The impact of these measures is visible as the total outstanding dues of states has reduced by around 25,000 crores to around 1,13,000 crores, thereby bearing witness that the implementation of LPS has reflected notable improvement with regard to recovery of outstanding dues of suppliers, including Gencos, transmission companies, and traders as well. Well, as of September 2022, the gross loan assets are at around 3,77,000 crores, and they have disbursed close to around 22,000 crores in the first half of the fiscal. The breakup of the loan book, well, that's up for you on the screen, with generation as well as distribution companies forming more than 90% of the book, and majority of the lending being done to government entities. Well, its gross NPAs has reduced to sub 5%, and the net NPAs has come in at its lowest we've seen in 6 years. Now, moving to the valuation front, well, the stock trades at around half price to book. That's post adjusting the REC stake, which gives some kind of comfort on the valuation front, even post the recent run-up in the stock. This is further backed up by solid dividend payout, which has ranged between 9 to around 12 rupees over the last few years. Now, with an eye on FY24, the street is hoping for loan growth of approximately 8%, driven by infrastructure financing opportunity, a pickup in the capex cycle, and greater credit demand by generation segment on heightened power demand versus supply. Margins could also bottom out even in a rising interest rate scenario as asset repricing happens every 3 years. Additionally, expect lower credit costs because of significant provision buffer in place, and also lower slippages because of stress already recognized in the private sector. Well, since it's a government-owned entity, there's always an overhang with regard to capital allocation, delay in growth revival, as well as resolutions, and also higher haircuts in the projects under resolution. One more risk is the free pass schemes by some states, well, that could affect the financial viability of some of these discoms. Well, that was about PFC, but we have run out of time on this edition of Inside Out. It's goodbye from Sonal and myself. But you keep writing to us and tell us what companies you want us to discuss and you want to hear about. We'll try to feature them on our show. Thanks so much for